China's economy is suffering from the opposite, deflation. Consumer prices declined in July for the first time in more than 2 years. People and businesses are not spending, and the world's second largest economy is struggling to revive demand.
Imagine a bustling marketplace in the heart of Beijing, once teeming with eager buyers and sellers. Now, the energy is subdued. Vendors quietly cut prices, hoping to attract customers, but the crowds hesitate, waiting for prices to drop further. This is not just a snapshot of a marketplace, it's a metaphor for the world's second largest economy, caught in a deflationary spiral that's proving incredibly hard to break. For 6 consecutive quarters, prices in China have been falling. If the trend continues for another quarter, it will tie the record set during the Asian financial crisis in the late 1990s. But what's causing this economic malaise? And why is it so difficult for policymakers to turn things around? To understand the issue, let's start with the basics. Deflation occurs when prices for goods and services fall across an entire economy. It sounds like a good thing. After all, who doesn't love a bargain? But deflation is not just about cheaper prices. It's a symptom of weak demand, where consumers and businesses pull back on spending, creating a vicious cycle of declining economic activity. It's important to note that deflation is different from disinflation, which is when prices rise more slowly than before. For example, in the United States, price growth has significantly slowed since mid-2022. But in China, prices aren't just slowing, they're shrinking, dragging the economy into a dangerous downward spiral. When the world reopened after the COVID-19 pandemic, many economies experienced a surge in prices as pent-up demand collided with supply shortages. Analysts predicted China would see a similar boom. Instead, the opposite happened. Consumer spending remained weak, and a real estate slump sapped confidence. In cities once buzzing with property developers, empty apartment buildings now loom like monuments to misplaced optimism. Regulatory crackdowns on high-paying industries like tech and finance further dampened spending power. Meanwhile, a push to increase manufacturing of high-tech goods flooded the market with supply, but demand remained anemic, forcing businesses to slash prices. The result? A perfect storm of low confidence, cautious consumers, and overproduction. At first glance, falling prices seem like a win for consumers. Cheaper cars, lower rent, discounted electronics. What's not to like? But deflation comes with a hidden cost. When prices fall, people delay purchases, expecting them to drop even further. This hesitation slows down economic activity, leading to lower incomes, less spending, and yet more price cuts, a cycle that's hard to escape. For businesses, deflation means higher real interest rates, adjusted for falling prices, making it costlier to borrow and invest. Debt burdens grow heavier, and the risk of defaults rises. This phenomenon, known as debt deflation, can push economies into recessions or even depressions. In China's case, the stakes are especially high, given its towering levels of corporate and household debt. China has faced deflationary pressures before and responded with bold measures like massive infrastructure spending and aggressive monetary easing. But this time, Beijing is treading carefully. The government is wary of piling on more debt and appears reluctant to ignite another property boom. President Xi Jinping is focused on steering the economy toward advanced technologies and sustainable growth, rather than relying on old playbooks. As a result, stimulus measures have been restrained. Interest rates have been cut multiple times, and banks have been instructed to extend credit. Local governments are buying unsold apartments to convert them into public housing. Subsidies have been offered for car and appliance purchases. Yet, these efforts have only provided modest relief. Investors remain pessimistic, and 10-year government bond yields recently fell to a record low, a sign of lingering economic uncertainty. Transportation costs have seen the sharpest declines, driven by lower car and gasoline prices. Car makers like BYD Corsa have slashed prices to compete in a saturated market, triggering a price war. Meanwhile, real estate, a sector once synonymous with China's meteoric growth, has become a drag on the economy. Oversupply and weak demand have left many cities with a glut of empty apartments. In manufacturing, government support through cheap loans and tax breaks has boosted supply. But with consumers reluctant to spend, inventories are piling up. The result is a sobering mismatch between supply and demand. Adding to China's woes is the looming threat of a trade war. As Donald Trump prepares for his return to the White House, he has vowed to impose a staggering 60% tariff on Chinese exports. Such a move could devastate bilateral trade and deal another blow to China's already struggling economy. Exports, which accounted for nearly a quarter of China's economic growth in 2024, may falter under the weight of these tariffs. Weakening overseas demand would make it even harder for manufacturers to raise prices, further entrenching deflationary pressures. China's deflation is not just a domestic issue, it has implications for the global economy. For foreign investors, the fallout is mixed. Chinese equities are vulnerable, with some companies facing declining earnings. Luxury brands and premium car makers that rely on Chinese consumers have seen sales plummet. Yet, the bond market has been a rare bright spot, as investors flock to low-risk government bonds, anticipating further rate cuts. Deflation in China could also temper inflationary pressures in other parts of the world, offering some relief to central banks battling rising prices. However, a prolonged deflationary spiral in the world's second-largest economy would be a drag on global growth. As policymakers in Beijing scramble to stabilize the economy, the road ahead remains uncertain. Will they double down on stimulus, risking more debt to reignite growth? Or will they stick to their cautious approach, betting on long-term structural reforms? One thing is clear: the stakes are high, not just for China, but for the global economy. The marketplace in Beijing may eventually bustle with activity again, but for now, the quiet is a stark reminder of the challenges ahead. Whether China can escape its deflationary spiral remains an open question, one with consequences far beyond its borders.